Hi guys. So today I'm asking the question: if a recession is coming, why is the stock market at the all-time high? Okay. Even as I'm recording this video, the S&P is making yet another all-time high. The Nasdaq is breaking higher. Tech stocks are surging, and yet all of the data that we're looking at, that I'm seeing, right, suggests that a recession is, if not here already, about to hit us very, very soon. And so let's look at some of that data. Well, I think before we get on to this data, think about the unemployment rate, right? So the unemployment rate has been moving higher over the last few months. It's been accelerating at such a rate that it triggered the SARM rule when we jumped up to 4.3% a couple of months back. That has 100% track record of predicting recessions. We also just had the longest yield curve inversion, right? That 210 curve inverted for the longest period ever. All right, we've recently uninverted following the Fed cutting interest rates by 50 basis points. Fed cutting interest rates by 50 basis points. The last three times they kicked off a cutting cycle, or should I say, the only three times they kicked off a cutting cycle with 50 basis point cut: 2007, 2001, 2020, right? All big recessions. Okay, outside of that, we just had this from Goldman's that said the front end of the yield curve is consistent with high recession expectations. And they're saying this: the change in the 12-month forward Fed funds rate signals 100% probability of recession. Okay. We've also just had some really terrible consumer confidence data. And so we can see the present situation index. Now, this is a survey, right? They ask consumers, how confident are you feeling about now? How confident are you feeling about the future? And the answer is, we're not feeling very confident at all. We can see the present situation index dropping very, very quickly, where forward expectations have been sort of fairly low for a while, but biggest drop in about 3 years. Okay, so the consumer is starting to worry, and the consumer's starting to worry because they see what's going on, right? While the market's going up, I think if you ask the majority of people out there, right, kind of feels like a recession's here. And there's no coincidence, right? It always feels like a recession is here before the recession hits, because recessions get backdated. The Fed is looking at backward looking data, right? Plus the revisions coming in. And so when you look at non farm payrolls, it tells us the amount of jobs created in the last month. Okay. And then you go forward a month and they revise those down. And then you go forward another month, they revise this month's down. So by the time we finally admit that we've got a recession, we've probably already had one for 2 or 3 months. And that's why maybe, it's starting to feel for many people that we're already in a recession, and yet it hasn't officially been called. This is the Bloomberg Economic US Labour Market Surprise Index. What does it mean? It basically measures whether the labour market data, things like the non-farms, the unemployment rate, initial job list claims, jolts, whether that data is coming in better or worse than expected. Okay. Are analysts being too bearish or too bullish? But what you can see is that certainly over the last few months, the labour market has been surprising to the downside. So coming in much weaker than analysts had been expecting, right? So that's obviously not a good thing, right? More signs that the labour market is weakening. Um, Next up, we have this from the conference board: conduct a survey, and they asked respondents, would you say jobs are plentiful, or would you say they are becoming harder to get? And so the number of people saying jobs are becoming harder to get is increasing, right? And or those saying jobs are plentiful are decreasing, or both. But we can see that whenever we've had this sort of rate of descent, okay, where more people are suggesting that jobs are becoming harder to come by, we've already been in a recession. So the recessions are shown in the grey shaded areas. And so it feels like the labour market is not just weakening, but this like get accelerating to the downside, right? Becoming much, much weaker very, very quickly, which is what you expect to see, right? If I had a chart of the unemployment rate, we can see it's like, slowly, slowly, then, it takes off like a rocket. Exactly what you see in recessionary periods. Okay. This out from Citi, who were looking at the same data we've just looked at, right? They're saying that the percentage of individuals finding jobs hard to get is increasing. Okay, but that could be a sign of just more people in the labour force, right? More people looking for work. They say no. They say it's an indication of weak hiring conditions. We agree, and they're saying it's reminiscent. Is reminiscent of the conditions in September 2001 when the US economy was already in recession. Now, the 2001 recession started in March. Okay, market had already come off a great deal by the time we got to September. It ended up going down a great deal more after September, but they're saying it's not looking good. All right, what do they say? A hard landing could be imminent. What's a hard landing? Well, if you picture the US economy as a jumbo jet, right, as a Boeing jumbo jet, right, the Fed's job when we had really high inflation was to slow the economy down, right? Slow it down. And we wanted the economy to lose some altitude, but not too quickly, right? Want it to come in sort of slow, have a nice soft landing, and then take off again once inflation was tamed. The opposite of a soft landing is a hard landing. And that's when, rather than slowing gradually and losing altitude gradually, the plane just nosedives into the tarmac. They're saying that's looking more likely. Why might that be? Fed funds rate. Fed fund rate's just too high for too long, right? And those high rates have ended up causing problems in the economy. The Fed are behind the curve, which is probably why they cut the 50 basis points at the last meeting, trying to get back on track. Well, if City are correct, and we do in fact get 70,000 new jobs in the non-farm payrolls, the Fed are way behind the curve. All right, that would be a really, really poor print, and they're suggesting that the unemployment rate could go up to 4.4%. That is not what the Fed wants at all, right? Especially not coming into an election. All right, so how would that look? Well, this is the non-farm payrolls, right? And we can see, right, clearly trending lower. But this was, I think, the lowest reading we've had over the last few years after COVID was 108,000. That came 2 months back. 70K would be somewhere down here, right? That is getting very, very close to negative numbers, right? That 70,000 jobs in the whole of the US economy. Bear in mind, probably 69,000 of those would be government jobs, or maybe even more, right? Maybe there's more than 70,000 government jobs and there's actually negative private sector jobs. So a pretty worrying picture, all right? And yet the market is still pumping. Why don't we think about that? Why is the market still pumping? Well, equity investors are not always that plugged into what's going on in the world, right? Lots and lots of passive flows into equities. Buy and hold. You just buy and hold your dollar cost average. You don't worry about what's going on. The S&P chart goes from bottom left to top right. Every month you get these passive flows going into mutual funds, etc., etc. That is bullish for the market. Okay. You also get, you know, corporate buybacks, right? Those corporate buybacks again are really bullish. These flows don't just stop overnight. Okay. One bad non-farm payrolls print, 99% of people ploughing money into this market have no idea what the non-farm payrolls mean. Okay, they're not looking at CNBC. They're not, looking at the macro data. You guys are, right, but you are unique in that respect. Most people on YouTube are watching videos of dancing cats, right? Not trying to get an idea on how the economy looks. And so those passive flows can dislocate stocks from reality for some time. Right? We've heard the saying that markets can remain irrational longer than you can stay solvent. I'd also, add this one. The stock market is not the economy. That's something you hear a lot. But I would add that the stock market is not the economy for a short period of time. right? If the economy keeps, deteriorating, sooner or later, the stock market will look down at the economic data and decide to catch down to it. All right. So be, we need to be really conscious of the messages that the market and the data is giving us. Why does City say it looks reminiscent of 2001? Well, the data, the non-farm payrolls have just been trending lower, right? Very similar to what we got now. The only difference is that the bubble had already popped by the time we got to 2001. We would end up going down a lot more. But yeah, in terms of the trend lower in job openings, yeah, you'd have to say, yeah, same. In job creation. Another thing I want to mention is that most recessions, right, occur at or not far from the all-time high. All right, and bear in mind these recessions are backdated. If we look at 1975, 1974, should I say, the market ran up, right? Pretty much, it was trending higher into the recession. We'd go on to drop 47%. That was November 73. The recession started, ended in August 74. 1981, July, the recession was called. That was right at the all-time high, bang on the all-time high. The market dropped 28% through August 82. In 1991, guess what? Market right at the high, dropped 20%. In 2001, March 2001, which was about 3 months, 2 months after the high. Okay. Again, we dropped 38%. 2007, December 2007, the recession was called right at the high, 56%. And we know what happened in COVID. All right. So it is very common for stocks to go up before they call the recession. Now, bear in mind, in all of these instances, apart from COVID, the economic data was deteriorating for a considerable period of time ahead of that recession, and yet the market was still going up. All right. And so don't be fooled. The stock market is telling us it's not a recession. The stock market is the least informed market of all asset classes, apart from, I don't know, some sort of crypto stuff. Look at gold. What is gold telling us? I've been bullish of gold, right? Super bullish. But even I'm surprised by how fast and how much the market is appreciating, right? Why is gold going up so much? Gold is telling us, right? Things are not looking good. Gold is not just a hedge against an inflation. It does really against a recession. It does really, really well when the Fed cut rates quickly. Because it's priced in dollars, you cut rates really quickly. It weakens the dollar. Plus, gold doesn't yield anything, doesn't have earnings, doesn't pay us a return on our investment. So yields coming down really quick. Just make it look more attractive. Gold is sending us a warning, guys. It always does. There's it isn't just going up for the sake of it, right? And look at 2 year yields. Okay, 2 year yields are on the verge of breaking down, just as they did in 2007, just as they did in 2020. Why would yields break down? I mean, we'd expect this a little bit, right? Because the Fed said they were going to cut rates and they have cut rates. But we look like we're about to fall off a cliff. Why would yields come down really quickly? Because they're saying the Fed is going to have to cut rates, not just cut rates, they're going to have to slash rates down by a huge amount. And they would only do that if we get a recession. All right, so the data is telling us a recession is very likely. The markets outside of equities are saying we think there's going to be a recession, and yet the equity market is still partying on, right? Like it's 1999, and we know what happened after 1999. So just be a little bit careful. If you like the video, please let me know, right? Click the like button. If you didn't like it, click the like button and tell me you hated it in the comments. And what I would ask you to do, guys, we are a young channel, right? We're trying to build up our subscribers. We're trying to deliver some value for you guys, right, outside of the normal stuff that you get on YouTube. So please click the subscribe button. And if you'll be interested in a free 7-day trial of our investing newsletter, you get all of this stuff. Plus, we go a bit deeper. We get really stuck into the macro, the market structure, CTA flows, hedging flows, you name it, right? We go deep. We're really trying to lift you guys and educate you guys and make you better investors. If you'd be interested in a 7-day free trial, click the link below in the channel description. Thank you very much, and be careful out there, guys.